A lot of people think they understand the difference between a bond and an asset-backed security. They'll tell you one is backed by a company's promise and the other by a pool of loans. That's technically true, but what most of the market is missing right now is the strategic and even geopolitical significance of a deal like the one Reliance is reportedly preparing. We're talking about a potential $2 billion asset-backed securities transaction set to be one of the largest ever by an Indian corporate. And it's a direct challenge to the conventional wisdom about how Indian companies have always financed themselves. This isn't just about a new type of bond, this is a bellwether event. It signals a fundamental shift in the Indian debt landscape. A shift that every investor, every corporate finance executive, and every student of global finance needs to understand. I'm going to walk you through why this deal is a game changer, what it means for the future of capital markets in India, and how it could influence corporate financing decisions globally. Here's what you'll take away from today's video. First, we'll break down the financial engineering behind this Reliance ABS deal, how it creates a transparent, potentially top-rated investment out of infrastructure and telecom cash flows, and why that can be more attractive to investors than a traditional corporate bond. Second, I'll show you why this deal moves securitization out of its old sandbox of shadow lenders and non-banking finance companies and into the mainstream for large, established corporates. Third, we'll analyze the geopolitical and macroeconomic backdrop that explains why Reliance is doing this now. And no, it's not a coincidence. Finally, I'll give you my take on whether this is a one-off masterstroke by Reliance or the start of a new, irreversible trend that will shape how corporate India funds itself for the next decade. If you're serious about building an edge in the market and getting a competitive advantage in your career, this is the place to be. Hit that subscribe button and give this video a like so you don't miss our next deep dive into a game-changing financial event. Now, let's get into the core of this. When a company like Reliance, known for a strong balance sheet and a massive corporate footprint, chooses to issue an asset-backed security, it's not because it has to. They could have easily issued a plain, unsecured bond and raised the money. The reason they're choosing securitization is because they're sending a very deliberate signal to the market. Think about the difference. With a traditional bond, the investor is lending to Reliance Industries as a whole. They're protected by the company's consolidated balance sheet across all its businesses. But with an ABS, the investor isn't buying Reliance's general credit. They're buying the rights to a specific, segregated pool of cash flows. Reports indicate it would be tied to infrastructure and telecom arms. So instead of relying on the success or failure of the whole company, you're relying on predictable, ring-fenced cash flows like mobile subscriptions or data services. It's a shift from betting on general credit risk to focusing on specific asset performance risk. What's the payoff? For investors, it means exposure to a very specific business line with transparent cash flows. That makes it easier to analyze and, in many cases, safer. For Reliance, it's about optimizing the cost of capital. The rating on this ABS could actually come in higher than Reliance's general corporate rating. Why? Because rating agencies don't need to evaluate the entire oil to chemicals to retail empire. They just look at the stability of the telecom receivables. If those are steady and predictable, the ABS could be rated above the parent. That tighter rating means a lower interest rate, a cheaper way to raise money. This is financial engineering at its smartest, breaking down risk into its components and optimizing pricing. Now, here's where most analysts miss the forest for the trees. For decades, securitization in India was almost entirely the domain of non-banking finance companies and housing finance firms. They used it to package auto loans, mortgages, or microfinance loans and sell them off to free up capital. It was a liquidity tool for lenders. Reliance is doing something totally different. They're not a lender. They're a massive industrial corporate. And this would be the first time we've seen a non-financial giant of this scale use securitization to fund core operations. That makes this deal a monumental shift. It's like if a big United States manufacturer suddenly funded a new factory by selling securities backed by the future cash flows of that factory's machines instead of issuing a regular bond. It just doesn't happen. Reliance is opening the door to an entirely new era. Once a company of their stature shows it can be done, others will follow. I'd be surprised if we don't see other Indian conglomerates exploring similar deals in the next 12 to 18 months, especially in sectors with predictable revenue like infrastructure, real estate, and digital services. So, why now? Globally, investors are still hunting for yield. With developed markets offering lower returns and more uncertainty, a highly rated asset from a fast-growing economy like India looks irresistible. At the same time, the post-2008 world made investors cautious about complex and opaque structures. A Reliance ABS directly addresses those concerns. It gives a European pension fund or a United States institution the ability to say, I'm not taking on Reliance's entire industrial portfolio, I'm only taking on the risk of their telecom cash flows. It's tailor-made for today's global fixed income market. And domestically, regulators like the Reserve Bank of India and the Securities and Exchange Board of India have spent years refining securitization rules. They've standardized structures, clarified tax treatment, and set risk retention requirements. That regulatory backbone is what makes this kind of corporate ABS possible today, something that would have been almost unthinkable a decade ago. Here's the surprising part. This isn't just about raising $2 billion. It's also about unlocking value. By turning their cash flows into a tradable security, Reliance is essentially putting a price tag on parts of its business. The yield and demand for this ABS will tell the market what telecom and infrastructure units are worth in real time. For a sprawling conglomerate where some of the parts' valuation is always debated, that's huge. It creates transparency and it sets the stage for future funding rounds, spin-offs, or even initial public offerings. So, the big question, is this a one-off or the start of a trend? From my perspective, this won't be a one-off. It's too smart and too aligned with what global capital is demanding. Transparency, efficiency, lower costs. Securitization ticks all those boxes. Corporates get cheaper, more flexible funding. Investors get cleaner, more transparent assets. It's a win-win. This is the financialization of corporate India's balance sheets. Moving beyond loans and bonds into a world where any predictable cash flow can become a marketable security. Toll roads, power plants, rental income from real estate, all of these could be the next wave of ABS deals. And here's how markets evolve. The more companies use these structures, the deeper and more liquid the market becomes. That lowers costs further, which brings in even more companies. It's the exact same cycle that transformed debt markets in the United States and Europe. What started with mortgages grew into auto loans, credit card receivables, even solar leases and music royalties. India is standing at the beginning of that same curve. And it's Reliance, the country's biggest corporate heavyweight, leading the charge. That alone tells you this is not a small experimental move. It's a template, a blueprint for how India's largest corporates will unlock value and reshape funding for a generation. This isn't just a deal, it's a turning point. A deal that doesn't just make headlines, it changes the game entirely. Thanks for watching. Don't forget to like and subscribe for more of the sharpest financial analysis on the internet. I'll see you in the next one.